have probably heard about this IPO, the one that is currently the talk of the town.
Yeah, I heard it gave almost 71% returns.
I didn't even get the allotment, yaar.
The one that gave a jaw-dropping 70% listing gains in a single day. But here is where the story gets interesting. So after watching sudden shoot up right in front of their eyes, many investors felt regret. So what happened next? Thousands of investors, retail investors, they saw the rally, they saw everyone making money, and they thought, this is it. This is my moment and I will not miss this. So they bought at the peak. But then just 2 days later, the stock crashed. It fell down sharply. All that excitement turned into panic and hope turned into regret. And those who bought at the peak, they were left staring at their screens, watching all of their money disappear. So now the billion rupee question is this IPO worth holding, or will it keep on falling down like Bajaj Housing and other recent IPOs? To find out the answers, I read the entire prospectus, compared it to its competitors, I dug into the risk factors, and what I found, it is not what the media is telling you. And in the next 7 minutes, I am going to share the uncomfortable truth that could save you from making a costly mistake. So I am talking about Grow IPO. And to understand this company, first we need to understand the broking industry. So Grow's competitors are companies like Zerodha and AngelOne. So let's take example of Zerodha and compare it with Grow. So both of these companies offer a platform with low brokerage, just 20 rupees an order, and it lets you make your own decision. It is a model built for a self-serve investor. Now here is where the story gets interesting. On the surface, both of the companies look the same, but their business philosophies are worlds apart. Now Grow has 60% more customers than its closest rival, Zerodha. So it is the biggest player in terms of user base. But hold on. When you look at the profits, the picture flips completely. Zerodha's net profit is a whopping 2 times higher. But how is that possible? How can a business with fewer customers be this much more profitable? So the answer comes down to one word: focus. Zerodha's approach is trader first. Their goal is not just to get you to open an account. Their goal is to make you a successful trader so that you stay for the long term, so that you be consistent, so their revenue is also consistent. Grow, on the other hand, is playing a different game, the scale game. They've positioned themselves as an all-in-one financial super app. Stocks, mutual funds, future and options, and even personal loans. Their goal is to attract the masses and then find multiple ways to earn from each customers. And it has worked wonders for their growth. In just 3 years, their revenue has exploded by nearly 10 times, from 427 crores to over 4,000 crores. But this is where we as smart investors need to pause and ask the most important question. Can this incredible growth story continue? To understand the answer to this question, we need to check the short-term quarter-on-quarter revenue trend. Now, if you compare the September 2024 quarter with the June 2025 or even September 2025 quarter, you will see a 10% dip in the sales. And going forward, the sales are likely to slow down due to multiple reasons, which we are going to discuss further in this video. So high PE plus slow growth in the sales equals danger. And if you miss these key changes, you might stay stuck in the wrong stock and lose lakhs of rupees. And this is exactly what I protect my RangaOne Basic members from. Inside RangaOne Basic, the moment a company's fundamentals change, like the profits are declining, the margins are shrinking, or the promoters start selling, we take actions immediately. You can have a look at our recommendation cards on our website. Each stock comes with a clear and specific action. If it is a buy, that means you can confidently enter. But if anything goes wrong with the stock, we don't stay silent. We take action immediately. We change the action from buy to hold or even sell if the situation demands it. So this is what makes RangaOne Basic different. We don't just give you stock names and disappear. We guide you through the entire journey. When to buy, when to hold, when to add more, when to partial sell, and most importantly, when to exit. We also provide you clear target so you always know your next step. So if you want proper buy, sell and target updates without any confusion, then you can join our RangaOne Wealth Basic Plan. And for more details, visit our website rangaone.finance. And with that clarity in mind, let us get back to grow and understand the two big reasons for the revenue decline. First reason, the party is over. Let us flash back to 2020 when all of us were locked in our homes. The interest rates were at rock bottom and the stock market was the most exciting game in town. Demat accounts were opening faster than ever, and this created a massive tailwind for the entire broking industry. But that was a once in a lifetime event, and to expect that to happen again is unrealistic. Second, we need to talk about the market saturation. Now you will hear people say that only 5 to 6% of the Indians invest in the stock market compared to 40-50% in the US. Now that sounds like a huge untapped opportunity, right? But let us look at the hard data. Now if you take a look at the government data, it shows that more than 90% of the Indians earn less than 25,000 rupees a month. The truth is, the population that can afford to invest is already largely into the market. The top 10 Indian brokers already have 40 million active clients. So the future growth is likely going to be stable and not explosive, probably in line with India's GDP growth of 6 to 7%. This is the very reason Zerodha strategy is so brilliant. In a saturated market, the best way to win is not to get more customers. The best way is to earn more from each existing serious customer. Now let us talk about the risks that are hiding in plain sight. See, every investment has a risk, and here they are significant. So first is the regulatory risk. Now recently SEBI tightened the rules for F&O trading, which is a major source of revenue for all of the brokers, and this caused a 50% decline in that segment. So rules can change anytime, and such risks are not in our control. Second is cyclicality. Now we think that brokers always make money whether the market is up or down, but that is a myth. When the market is in a downtrend, enthusiasm fades, trading volumes drop, and the broker's revenue take a direct hit. And in the case of this company, all of their business lines, whether it be loans or wealth management, are tied to the same market cycle. There is no defensive cushion over here. Given all this, why did the company demand such a high price in its IPO? See, they raised over 6,600 crores, and a massive 85% of that went to the already existing investors who were selling their stake. Only 15% went to the company, which they will be using for marketing, cloud services, and giving out more loans. So there is no groundbreaking innovation over here. They are using the money to protect the very scale which is already under threat. So now we come to the final question, the valuation. Is the price justified? Now see, at the time of making this video, the company's PE ratio is around 51. Now that is nearly double its peers, and the price to sales ratio is 22, while competitors like Angel One are at 5 to 7. So you are definitely paying a massive premium. So what is the final verdict? See, we have a company that is the master of growth and has built incredible scale, but it operates in a cyclical industry with growing saturation and regulatory risk. So its biggest advantage is not secure, and its valuation is stretched far beyond its peers. So my analysis suggests that the current premium valuation is not justified by the future potential, and caution is required over here. And just like that, I share important market updates and stock specific actions in my RangaOne basic plan. So when you join my RangaOne basic plan on the website, you don't just get updates on the platform, you also get access to a dedicated Telegram community as well. So in the Telegram community, you receive daily market updates, and whenever I recommend buying a stock or selling a stock, you receive instant notifications on Telegram. So you stay updated at all times without missing anything important. So growth story is impressive, but the numbers demand caution. And 110 is a very important level to keep an eye on, as it is the IPO band price. And if the stock goes below that level, then we will see a strong selling pressure. So that's it. That was my analysis on Grow IPO. Let me know if you have invested in the stock in the comments below, and also let me know which company should I analyze next. So this was Sanika from RangaOne Finance, and I will see you very soon in the next one. Till then, bye bye.